Higher savings rates tend to have higher steady-state levels of capital and output per worker. When we compare countries with different savings rates, we can see the significant impact on their economic output. However, diminishing returns to capital mean that investment alone cannot sustain long-term growth. In early stages of capital accumulation, returns are high, but as capital increases, each additional unit generates less additional output. That's why technological progress is essential for continued improvements in living standards. To summarize, economic growth depends on capital accumulation, population growth, and technological progress, with technology being crucial for long-term growth. In this chapter, we'll explore the fundamentals of money, banking, and monetary policy and how they influence the broader economy. Money serves three essential functions in an economy. First, as a medium of exchange, money facilitates trade and economic transactions, eliminating the need for bartering. Second, as a store of value, money preserves purchasing power over time, allowing people to save for future needs. Third, as a unit of account, money provides a common measure of economic value, making it easier to compare prices of different goods and services. The modern banking system operates on fractional reserve banking, where banks keep only a portion of deposits as reserves. When a customer deposits money, let's say $100, the bank is required to keep only a small portion as reserves. The bank can then lend out the rest of the money, in this case $90, creating new money in the economy. The reserve ratio is the portion of deposits that banks must hold as reserves. In our example, a 10% reserve ratio means banks keep $10 for every $100 deposited. This creates a money multiplier effect. With a 10% reserve ratio, the banking system can potentially create up to 10 times the initial deposit amount. Central banks like the Federal Reserve are responsible for controlling a nation's money supply and implementing monetary policy. Central banks use three main tools to implement monetary policy. First, open market operations involve buying or selling government securities to increase or decrease the money supply. Second, the discount rate is the interest rate at which central banks lend to commercial banks, affecting borrowing costs throughout the economy. Third, reserve requirements determine the minimum amount of reserves that banks must hold against deposits, influencing their lending capacity. Monetary policy can be either expansionary or contractionary, depending on economic conditions. Expansionary monetary policy increases the money supply and lowers interest rates, stimulating economic growth and combating recession. This leads to increased GDP growth over time as businesses and consumers have greater access to affordable credit. In contrast, contractionary monetary policy reduces the money supply and raises interest rates, slowing economic activity to control inflation. This typically results in declining inflation rates over time as the economy cools and price pressures diminish. The transmission mechanism explains how central bank actions affect the broader economy through multiple channels. The interest rate channel is the most direct pathway, where changes in policy rates affect borrowing costs for businesses and consumers. The asset price channel works through the impact of interest rates on stock prices, housing values, and other assets. The exchange rate channel involves how monetary policy affects currency values and international trade. The credit channel focuses on how monetary policy influences bank lending and credit availability. Ultimately, all these channels converge to influence aggregate demand, which affects economic output, employment, and inflation.